Technical analysis. Here are the items that we will cover. Technical analysis has historically been used by analysts and traders. Now it has also gained acceptance among regulators and the academic community. Essentially, what we will study in this reading are the various tools that are used in technical analysis. First, let's go over a basic definition and the scope of technical analysis. Technical analysis is a form of security analysis. Technical analysis uses price and volume data, which is often graphically displayed. The most basic form of technical analysis would involve looking at a line chart of a given stock or some other security, where we look at the prices over time, and then we use this data about the stock price and potentially volume, which is depicted at the bottom of the chart, to determine what the trend is and whether or not to purchase this stock. One of the advantages of technical analysis is that it does not require a detailed knowledge of the underlying instrument. So if you are evaluating the General Electric stock, for example, with technical analysis, you would be focused on the market data related to General Electric, the stock price currently, the stock price in the past, the volume data, and so on. You really do not need to know too much about the business or the various businesses of General Electric, the industries that it operates in, the economy, and so on. The objective of technical analysis is to make a buy, sell, or hold decision. You will often hear the term technical data, and just to clarify, technical data simply means price data, volume data, and the trends associated with price and volume. The underlying logic behind technical analysis is as follows. Number one, that it is supply and demand which determine prices, and therefore changes in supply and demand cause changes in prices. If you take a given stock, let's say that it has a supply at a given point in time, and there is also a demand for that stock. The price at a given point in time is determined by the intersection of the supply and demand. This is basic economics. If there is an increase in demand, the demand curve will shift to the right and the price will go up. Another example is that you have a given supply and a given demand curve. Let's say that there is a secondary offering of this security, which will cause the supply to increase. Assuming the demand is the same, according to this supply and demand model, the price is likely to come down. Prices can be projected with charts and other technical tools. So as shown over here, we try to project the future price using charts and graphs, which we will be studying in a lot more detail. Moving now to the principles and assumptions. Technical analysis can be thought of as the study of collective investor psychology or sentiment. You need to recognize that human behavior is driven by emotion. Therefore, human behavior is not always rational. Market participants are human, and since it is human beings who are buying and selling stocks, then irrational human behavior means that the